really pleased to be here with Bruce Richards from Marathon Asset Management. He doesn't really need an introduction, but I will say I've been interviewing Bruce for at least a decade now, and he is the first person that I heard make this call on software being essentially endangered by AI, and that private credit was overexposed to software. It was over a year ago. And so I'm glad to be able to talk to you, Bruce, about that now, because this morning you put out a LinkedIn post saying, maybe we can draw some parallels between what happened to energy in the mid-20-teens and what's going to happen with software now. At that time, we had a 20% plus default rate for energy credits, and you think that we could go to 15% for highly leveraged software companies. Help us unpack that call.
So when you draw that parallel, I'll talk about the call in a second. When you draw that parallel, it's a difficult parallel to draw because oil and gas has nothing to do with software at a certain level. And any rating agency or industry practitioner would know that. In fact, the man in the street would know that. But here's where I see not the trees, but from up above, 1,000 feet down, looking beyond, the actual parallels that are strikingly similar that our viewing audience should understand. So number one, there's a major technological change that changed forever oil and gas. And it's called horizontal drilling or fracking, where you used to go down vertically, and now you can go down horizontally. And what it did is it completely changed the pricing structure for oil and gas. And with all the leveraged companies in the high yield market, in the broadly syndicated loan market that had that exposure, all of a sudden, when the pricing structure got crushed, all of a sudden, all the capital dried up. And you had, after that 2014 and 15, excess of drilling and all the financing required to support all that drilling, in 2016 and 17 and 18, you had back-to-back years of 15% default rates because of three things: the technological change, the change with respect to capital availability, and the pricing structure of the underlying commodity itself. And so as you draw that parallel to software, you have the same thing. You have this massive technological change called AI. It's going to affect the pricing structure, which is ARR, right? And capital is now drying up. Who will finance these companies going forward? And so I see those parallels. So when you go to the public equity market, there's no leverage really. You look at NASDAQ, S&P 500, the Russell 2000, look at the software companies in these industries, they have 0.5 turns of leverage, half of a turn of leverage. Not much leverage at all. You go to the broadly syndicated loan market, 5.2 turns of leverage for a software company. Because when you come to the broadly syndicated loan market, the rating agencies and investors have discipline. They say no more than 6 turns of leverage, or we can't let that loan go into a CLO, or if it does go into CLO, it's going to have a much lower credit rating. So where do all the highly leveraged broadly syndicated loans go to, or I should say direct loans go to? They go to the private credit market of direct lending, where they're 8, 9, 10 times leverage on software companies. And so what that leads you to is this. The public companies have really nice margins, generating free cash flow, and can defend the fort. In other words, creative destruction can make them a better company in an AI world. They have a really good fighting chance to do so. If you're 10 times leveraged or 8 times leveraged or even 6 times leveraged, then all your cash flow is going to debt service. You have no cash flow, no free cash flow to be able to reposition the company, make the investment you need to make to transition to an AI-first software business. So I think the default rates, now that the bed's been laid and there's no out, in the years 27 and 28, when a lot of these 20 and 21 and 22 deals come due, loans are 5 and 7 year loans. When these loans come due, there's no refinance capital available. And so there's a very big parallel, and I'm calling for a 15% default rate. I can't tell you if it's year 2027 or 2028, but it's coming, and it's unequivocally coming because the valuations have been reset lower, and anyone that's a lender today should be lending at 4 turns debt to EBITDA, not 6, not 10, and they should be getting paid a higher rate because it's a uncertain business to lend on.
By the way, before I get into why private credit has so much exposure here. What do you think of the public companies that have been crushed because of this narrative, but maybe aren't going to have their lunch eaten by AI?
I think there's some good value there.
Yeah.
And so you see the software industry itself has bottomed a couple weeks ago in terms of, or in the last couple weeks, in terms of valuation after a big trade-off. And so they're actually up off the lows. And those companies aren't levered, but also have to deal with transition. So on some of those companies, you're going to see, significantly higher prices because of the creative destruction will allow those companies to be transformed into an AI-first software. And some of those companies actually won't make it, and you'll see some losses. But you have all the upside, if you're buying an index of it, to offset your downside. And so I'm actually neutral to slightly constructive now on software. I'm not saying we've seen the bottom, but I think that I'm not so bearish now in the public equity markets for software because there's been this massive adjustment. We don't know who the winners or losers are yet, so it's hard to pick single names. But for an overall industry, I think there's been a massive adjustment, which offsets some of the uncertainty. In the broadly syndicated loan market, software names are off year to date around 11 to 12 points, and they're 5.2 times leveraged. So then you have to say to yourself, okay, if a broadly syndicated loan is off 11 to 12 points, then how much should a direct lending loan be if it has much more leverage to similar type companies? Less than 10, 11 points? About 10, 11 points? Or substantially more? I'm not going to answer that, but I think everyone has their own conclusion on that.
Why is private credit so exposed? And by the way, when we ask on my show, I anchor Bloomberg's Open Interest every weekday from 9 to 11.
Great show.
When we ask, most of the fund operators say, that's everybody else, right? We're not exposed. So
everyone's rearranging the furniture right now. Yeah. It's like rearranging the chairs on the deck, right? As the saying goes. And that software company, it's a healthcare company. That software company, that's travel and leisure. That software company, that's an education company. No, they may support healthcare or education or travel and leisure. They're software companies. And so everyone's trying to re-rate or recategorize what the exposure is to say, I don't have that much software exposure. The simple fact is there's three numbers to remember: 3, 13, and 23. 3% of the high yield market is software. 13% of the broadly syndicated loan market is software. 23% of the direct lending loan marketplace is software. And so it has that exposure, regardless of where you want to put the chair on the deck. It has that exposure, 23%. Now, some managers have 26% or 32%. Some of them have 15%. Different managers had different, investment discipline. But why do you have 23% in that one industry sector when only 1% of private companies are software companies in this country? I don't know. I don't have an answer for you. We have 1% exposure to software, and it's a 4 turns debt to EBITDA, loan. So I can't tell you why it's 23%, other than it was a big gold rush. Everyone had convinced themselves that you can finance and put a lot of money out the door by financing a software company because they had nice margins and presumably good growth rates. Most of those growth rates haven't panned out, though. And so now you just have a much highly valued company, too highly valued company with too much debt on it. And that's going through a technological transformation with a pricing transformation that we've yet to see, but is undoubtedly coming as you pay per seat or you pay per token, or the pricing structure starts to change.
So what happens now to private markets? And everybody's, especially this conference, talking about yesterday, Mark Rowan said, we're due for a correction in private markets. But obviously there are different businesses. Private equity is very different from private credit.
Yeah. So I think private markets are actually in pretty good shape. I think there's some pain out there. If you have a cockroach in your portfolio, people are going to want to, a company that, committed fraud, that's an issue. I think that's very idiosyncratic and very rare, but
you're not worried about the tricolors, the First Brands, the MFS?
I'm not worried about that being systemic at all. It's not like liar loans on the subprime housing market back during the GFC that polluted the banks. The banks don't have this exposure. It's not that broad. It's very, very isolated. There will undoubtedly be more as people start to put the microscope on all these companies and bring religion back to how they lend and lend in a much more disciplined way. And so number one. Number two, I think away from software, because I think capital's really not available to lend to software companies right now today in the private markets, other than the current lender wanting to amend and extend their loans, pick that loan, but the new money coming in isn't going to come in at more than 4 or 5 turns of leverage, because that's where a highly leveraged company should be financed. And software is inherently a riskier business today, and so it should be financed not only with that lower leverage, but with a higher spread, because you have greater risk given the uncertainty. As it relates to the rest of the economy for now is doing pretty well. Our natural growth rate here in the United States is 1.8%, and we're growing at a faster rate than that. We'll have to see with how oil prices are going to impact that, but holding all things constant from what we know from the start of the year, $30 trillion GDP here in the United States. You grow at 2% a year, that's $600 billion a year. I had penciled in we're going to grow at $1 trillion this year. Much more, because the reindustrialization of America, because bringing the supply chain back, because of everything that's going on with data centers and building out those data centers, as well as the economy. We talk about the consumer being a K-shaped consumer. It's an E-shaped. Economy starts with the letter E, not with K. And the middle class, that big line in the E, is a pretty big cohort.
By the way, this is an important point that you're making, Bruce, and because it isn't what we hear every day on my show. People talk about the K-shaped economy all the time, the idea that the wealthiest, the top 10% are powering more than half of the economy, and that the lowest 50% is having a real problem. We see, I think we lost 70 or 80,000 manufacturing jobs in 2025, so I don't see the reindustrialization happening.
But let me just tell you, the E-economy, and I'm talking capital E on economy, and there's that 10-20% at the upper end that owns assets, that have good credit scores, that power a lot of the spending. Got it? Check. And there's a lower 40% of the cohorts that have poor credit scores and are indebted and struggle and don't have much assets, certainly on a net basis after debt. But the middle 40% is the middle part of the E, and let me tell you about the middle part of the E. Wages have risen sufficiently high, with inflation having softened just a little bit, although it's ticking up now with energy. But it's the first time in years that wages have risen above inflation, so they've actually had a chance to accumulate wealth. And the average middle class in that 40% has $250,000 of net worth, so $500,000 of assets, with $250,000 of debt for $250,000 of net worth, with a savings rate that's starting to improve marginally. And that part of the economy is actually doing well. And so we talk about the K because we talk about extremes. That's politics for you, and that's people glamorizing the extremes. But there's a real E in the middle that people forget about that also powers the economy. It's a big part of this. It's not only the K-shaped economy for consumers that is an E. The K-shaped economy is also for companies. Growth companies versus companies that struggle, but there's a big middle class there of companies that do just fine, that represent mid-market companies. And so if you look at, the Mag 7 this year, it's down a few percent on the year. Well, if you look at materials and industrials and energy companies, they're up 25% on the year. And so there's a big middle class of companies that we also think represents the economy. And we think with the economy doing fine in terms of growth, A, B, the big tax receipts coming in because of OBBA, and what it means for an average taxpayer getting back $1,000 in the middle class, more than they had. It's more discretionary money, more savings, and so I think the consumer for now is fine. The big delta, the big change is oil. And I've run my internal model, and it's really instructive. for markets, and I think for how we should think about it if you want to hear it.
So I do, because you have talked to me before about you believe manufacturing is coming back to this economy, and you're bullish the economy, as we just heard. Now, with the war in Iran, we are seeing, Brent crude spike from mid-60s to low 80s, and inflation is going to limit the amount of cuts the Fed can act on. I mean, how is that going to affect the economy and your outlook?
It's big. It's big, and so the key here is duration. Duration of how long this lasts, and what's going on in the Strait. So let me frame it for you. 100 million barrels of oil get produced every year in this world, every day in this world, 100 million. And 20 million come through the Strait. And pretty soon, Qatar is going to have to shut off their oil and gas, more importantly, their gas manufacturing and production. And it's going to take a week to 2 weeks to shut it down. It'll take a week to 2 weeks to fire it back up, because if you can't ship it out on these big LNG tankers, then where can you put it? And they're starting to get to that point where can you put it? And that's true. That's true of oil. It's true of gas. And so Henry Hub in the United States has gone up 5% since the war began 4 days ago, but in South Korea it's went up 75%. The price of gas. And the price of gas is up 50 to 60% in Europe, because you're very dependent on these shipping lanes. And so you got to be very careful what it means. So here's my model, and here's what you need to think about. $60 oil, we grow at 3% in the United States. I think it's a lock. I think it's probably, the surprise is going to be the upside of that in terms of the growth expectations I have for this year. Take oil up $20. That's your magic number. It's for every dollar, but I'll extrapolate for you. Take it up $20 to $80. I think growth rate goes to 8, from 3% to 2%. So you take 1% off at $80 oil. Now let's go to $100 oil. You're at 1% growth. Let's shave off 1%. 1% growth. Which means you have not only inflation, as you mentioned, but lower economic activity. I'm calling that stagflation. You take oil, not for a spike, but sustain it there at $120 an oil, a barrel for oil, $120 for Brent, you're at zero growth. That's the trigger for a recession, $120 a barrel. That's what I believe, and I believe that's what the markets believe, although no one said it yet. That's a very simple model, and let's lock that in. $100 is 1% growth, 120, and the president knows this. And they want the war to be short, be over in a few weeks, to get that Strait open, to get oil pumping again, to get the economies of the world back on track, and having solved this problem that the U.S. has and that the West has with Iran. And if he can pull that off, that's legendary. And if he can't pull that off, it's going to take much longer in terms of duration to stretch on for a really long time, then that's really a problem, because it's going to eat into economic growth. And that changes the whole equation for what you expect in terms of, growth and financing and equity markets, and because it very much drives valuations.
Bruce, I'm seeing red flashes here, so I know that we're out of time, but I do want to get to the acronym that you coined on our television program this morning, which is HALO.
HALO.
This is, I guess, depending what happens in Iran, obviously, your investment thesis right now, and it stands for hard assets, low obsolescence. How do you come to that and expand on it?
Yeah, so, in asset-based lending, when you lend against aircraft or engines or cranes or turbines, and you have $300 million of collateral and you have a perfected interest in it, and you're making a $200 million loan, you have a $100 million margin of safety, and it's a mission critical asset to the company. So when we take engines and we lease them to Delta Airlines, that's a great credit. That's a great operator. And we're making a nice return because we secured these assets. It's hard assets, low obsolescence. Okay? And when you think about direct lending as well, the opposite of hard assets and low obsolescence is software.
And there's no software names that you like, by the way. There's, in terms of the debt, right? There's nothing that's fallen far enough that you're bargain hunting.
I think the shoe for financing has dropped. But I don't think the other shoe has fallen in terms of defaults and defining who the winners and losers are. It's too early to tell that. But I do know that they don't have free cash flow after debt service, most of these companies, and it's going to be very hard for them to reposition. And so the public companies are going to be the winners in that space, not necessarily the private equity companies. But again, private equity has all the upside, and so they're so good at what they do that they'll figure out how to reposition a lot of these companies to get those much higher multiples that can offset some of that downside. But back to direct lending, if you have a direct lending loan to a company that does, I don't know, sprinkler systems for commercial buildings or concrete with rebar, that's going to help power the reindustrialization of America. That's a very stable business to be in, and so we like those type of businesses, hard assets, hard to replicate, real economy assets that we can lend against, either their operating businesses when doing direct loans or hard asset lending when we're doing ABL.
Bruce, always a pleasure. Thank you so much for joining us.
Thank you, Matt.
Bruce Richards, Marathon Asset Management.